Good afternoon, everyone, and welcome to today's Headline Roundup. Dennis, you ready to roll here?
I am, Mark. I thought I'd pop a video up here a minute so everybody can see that I'm here in the office and ready to go to work today. So there's a lot to talk about, a lot of changes taking place all across the economy. So that said, I'm going to jump in and we will take a look at what we're going to talk about this week. Today's August 29. Quick reminder, we'll be back again live in 2 weeks on September 12. Next week, September 5, is the Labor Day holiday. There will not be a headline roundup on Labor Day. So wish everybody a great holiday weekend as summer kind of wraps up here. So forecast confirmed. Are we getting inflation now followed by deflation? We're going to talk about a lot of layoffs that have been announced recently. We're going to talk about more housing market updates. I'm going to talk about why Jefferson was correct. And here at the last minute, I did put an update in as far as the student loan forgiveness that has now been proposed. And I'll talk a little bit about that as well. That could be timely and affect some of you. So again, a lot to talk about here. If you have a question as we work through this material, there's a question box on the right-hand side of your screen. I will be sure to pop that up by the end of today's broadcast. But as we go through it, if you have a comment or question, Mark will again help me keep an eye on it. So, excuse me, let me start, excuse me, about this forecast being confirmed, inflation followed by deflation. Now, this economic belief that I have held for a very long time comes from Thomas Jefferson, one of the founding fathers. This will actually not be surprising at all to longtime viewers of the Headline Roundup broadcast. Thomas Jefferson, there's three quotes here that I have put together. One, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The Federal Reserve is a private group of bankers, so we are doing today exactly what Thomas Jefferson warned us not to do. Jefferson did not hold bankers in very high regard. The second quote that you see there is from Jefferson as well. He said, "I believe that banking institutions are more dangerous to our liberties than standing armies." And then finally, Jefferson said, "The issuing power should be taken from the banks and restored to the people to whom it properly belongs." He said, the bank should not issue currency. People should decide what is used as currency. And for much of history, people have decided that they would use precious metals like gold and silver for currency. So for all the disdain sometimes in which the founding fathers are held and a lot of our history now is being ignored in my view, Jefferson had a very keen understanding of how economies and banking works. So Jefferson has really warned us to avoid the path on which we're traveling, and Jefferson told us exactly what the outcome would be, and that's now exactly what we're seeing. So that said, the Fed, this private group of central bankers, is now talking tough. The Fed just concluded their Jackson Hole, Wyoming meeting. This is from an article I found on the topic. U.S. stocks tumbled Friday, with the Dow Jones Industrial Average closing more than 1,000 points down for its worst daily percentage drop since May, after Federal Reserve Chair Jerome Powell said the central bank will continue its battle against inflation until the job is done of getting the cost of living back to its 2% target. Now, for reasons that I'll talk about here in some level of detail, I believe the Fed will reverse course despite the tough talk of Powell. And, you know, the cost of living back to the 2% target is a very subjective measure because not only is the consumer price index a highly flawed metric, it doesn't really reflect the true rate of inflation. The Fed has also changed the way they calculate inflation now using the consumer price index, taking an average versus its prior method where they actually look at the actual numbers. So that is a watered down number that has been manipulated, has been altered to make the reported inflation rate look more favorable. U.S. stocks fell Friday with losses led by the technology-heavy NASDAQ Composite after Powell reiterated his resolve to bring soaring inflation under control through higher interest rates. In remarks that were more hawkish than many investors anticipated, Powell tried to dispel any hopes for a less aggressive monetary stance by insisting that the central bank will persist in its inflation fight, even if that means causing some near-term economic pain for American families. And Powell actually did use those words. Here's what he said. Reducing inflation is likely to require a sustained period of below-trend growth. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. Now, I've put my version of a translation at the bottom of this screen. We have no choice. To get inflation under control, we must experience a painful deflationary period that purges debt excesses from the system. The reckless currency creation in which the Fed has engaged has simply exacerbated the debt problem, and now it's time for American households and businesses to pay the price for our monetary indiscretions. See, currency is created literally out of thin air to mask the symptoms of debt excesses. I've often talked about the fact that when you create currency, you're adding debt to the system, you're not reducing debt. So you're trying to solve a debt problem by creating more debt. You don't have to be an economist to figure out that that's not going to work. Michael Snyder, whose work I follow, talks about the fact that the layoff tsunami has begun. This was, to me anyway, a very shocking statistic. 50% of U.S. companies plan to eliminate jobs within the next 12 months. Snyder said this, if half the firms in the entire country really do cut jobs over the next year, what will our economy look like afterwards? That's a really good thing to think about. Now, I'll talk about the survey, or Snyder talks about the survey, and we'll get to that here in just a second, but think about this. If half the firms in the country really do cut jobs, what will the economy look like afterwards? Snyder says all over America, companies are anticipating that a major economic downturn is coming in 2023, and a lot of them are already planning to shed workers in order to cut costs. Of course, this sounds so much like what we went through back in 2008 and 2009. Millions of Americans lost their jobs during the Great Recession, and it was a very dark time in our history. So are we on the verge of seeing a repeat? Snyder said, let's hope that's not the case. But a brand new survey was just released that discovered 50% of all U.S. companies plan to eliminate jobs in the next 12 months. This is from CNBC, quote, meanwhile, 50% of firms are anticipating a reduction in overall headcount, while 52% foresee instituting a hiring freeze and 44% are rescinding job offers. This is according to a PwC survey of 722 executives, and the survey was conducted just a few weeks ago. These are executives' expectations for the next 6 months to a year, and therefore they could change, they may evolve. That's what a Bhushan Sethi says, who is the co-head of PwC's Global People and Organization Group. So Snyder simply asks, can these numbers be accurate? He said, I knew things were bad because I write about this stuff on a daily basis, but I didn't think that half the firms in the entire nation were already looking to cut workers. Wow, at this moment, I'm at a loss for words. He said, it's going to get bad out there, and if you have a good job right now, try to do whatever you can to hold on to it. Now, sadly, some of the biggest names in the corporate world have already started to lay off workers. Ford Motor Company just announced it will be laying off roughly 3,000 white-collar and contract employees. This from the article that reported it. Ford Motor confirmed Monday it is laying off roughly 3,000 white-collar and contract employees, marking the latest in its efforts to slash costs as it makes a longer-range transition to electric vehicles. Ford sent an internal email Monday to employees saying it would begin notifying affected salaried and agency workers this week of the cuts. The email was viewed by the Wall Street Journal. Wayfair has also decided it's time for layoffs. Home goods company Wayfair decided to cut 870 workers to help manage operation costs and, quote, realign its investment priorities following the coronavirus pandemic, the AP reported this week. Snyder said, I thought Wayfair was doing quite well, but I guess they're not. Peloton, the exercise, the bicycle company, which incidentally, Peloton has never made a profit. I've talked in the past how what we're seeing today with successful IPOs taking place with companies that have never made a profit, Peloton being one of those, it reminds me a lot of what we saw 20 years ago when the tech stock bubble blew up, and I was around and I remember that. Seeking to cut costs and end a flood of red ink, Peloton is planning to raise prices on key products, shutter stores, and lay off hundreds of workers, according to a memo from CEO Barry McCarthy. And even Groupon is getting in on the act. 500 of Groupon's workers will now be updating their resumes. Chicago-based Groupon today laid off more than 500 of its employees. That's 15% of its 3,416 person headcount, according to posts from former employees on social media. The reduction impacted workers and teams, including merchant development, sales, recruiting, engineering, product, and marketing. Other big names that have announced layoffs in recent weeks include Best Buy, HBO Max, Shopify, Remax, and Walmart. In fact, I talked about Remax on last week's Headline Roundup webinar. Remax, I believe, going from memory here, was laying off 17% of its workforce. So these are deflationary signs. When debt is purged from the system, and when you think about deflation, an extreme example of a deflationary environment was the 1930s. Now, the 1930s saw some currencies in the world that were tied to precious metals. That is no longer the case today. So I believe that this rubber band has been stretched very, very tightly, to use that analogy. Snyder says this is just the tip of the iceberg. As this new economic downturn deepens, countless more Americans will lose their jobs. As that happens, all of a sudden there will be vast numbers of people that can't pay their mortgages and can't make their rent payments. And that will make our new housing crash even worse. We are now very clearly past the peak of the housing bubble, and the ride down is going to be really painful. This time last year, the housing market in California was extremely hot, but now the numbers are definitely heading in the other direction. Sales volume of single-family houses in California dropped by 14% in July from June. In 1 month, sales of single-family homes in California dropped 14%. Year over year, the decline was 31%. And it was a 13th month in a row that there were year-over-year declines. So for now more than a year, the California real estate market has been cooling. Comparing the year-over-year numbers, the recent numbers are lower than the year-ago numbers, and that's for the last 13 months, and that's consecutive months. So this is a trend. Sales volume of condos dropped 18% in July from June, and 36% year over year. Now, prices eventually follow volume. If homeowners can't sell homes and they want to sell their home, they start to drop the price. We're starting to see that. The median price of single-family houses dropped 3.5% in July from June. That's down for the second month in a row, slashing the year-over-year gain to just 2.8%. So prices haven't quite caught up to declining sales volume, but they will. That's the way it always works. Snyder said, if you're trying to sell a house right now, and I would echo his advice, I would encourage you to try to get that done as quickly as possible before prices fall precipitously. The Dow was down 643 points on Monday. I already talked about the fact that on Friday, the Dow was down 1,000. These are deflationary signs. Stock values, real estate values, historically speaking, decline when we get to a deflationary environment. The Dow, as of this writing, had fallen 643 points. That was the worst day since June. It's now fallen 1,000 points since this article was published, the worst day rather since May. So we're seeing stocks declining. We're seeing real estate start to decline. We're seeing deflationary signs. Now, Snyder says, I think a lot of people want to get out of the market before the summer ends. Needless to say, however, there are many that are anticipating that the last few months of this year will not be kind to financial markets. On September 29, 2008, the Dow dropped 777 points. That was a brand new record at that time, and it set off mass panic on Wall Street. Now, keep in mind, September 29 of 2008 was well into the stock market decline. I would say that we are well into this market decline as well. If you go back and look at the decline that occurred from 2007 to 2009, the market peak was in July of 2007. The market didn't bottom until March of 2009. So 6 months before the market bottom, we saw this record drop in stocks. And Snyder asks a very good question. Could we see something similar once summer is over? And he says, only time will tell. What we do know is that the U.S. economy is really starting to implode, and the stage is being set for the sort of historic economic meltdown that I portrayed in my books. So I believe that Jefferson was correct. I believe that we are seeing inflation, and now we're starting to see the signs of deflation. And keep in mind that, you know, these lines, these transitions from inflation to deflation are perhaps not well defined. You'll see inflation and deflation as this transitions. Now, Mises is a site that really reports economic news through the lens of Austrian economics, which I tend to favor. So with that bias fully disclosed here, let me jump into this article. Richard Nixon announced the US dollar would no longer be redeemable in gold in August of 1971. That was supposed to be temporary, as you all know if you're longtime viewers of the Headline Roundup podcast. Yet, 51 years later, here we are. The gold standard was gradually destroyed in the 20th century. We have no currencies now that are being backed by gold, and people now are experiencing the consequences. Their currency doesn't buy as much as it used to, and the economy is weaker. Now, Murray Rothbard wrote a book titled, What Has Government Done to Our Money? And in the 4th chapter of that book, which this author talks about, Rothbard talks about the steps the government took to end the gold standard. So when you look at the gold standard, there was the classical gold standard that really was in place here from 1815 to 1914. Now, there were a few exceptions to that rule. If you take a look at the Second Central Bank of the United States, that was actually set up in 1816 after the War of 1812. And the dollar was backed by gold, but that backing was watered down. The panic of 1837 set in as a result. During the Civil War, the US dollar was backed by gold as well as government debt, and that led to the Long Depression of 1873. Then in 1914, a year after the Fed was born, dollars were printed at in excess of gold reserves. So at this point, the dollar was really backed 40% by gold rather than 100%. Now, the key, you'll notice I put a presenter's note at the bottom, and I did that just so I could remember to make these comments to you as I was putting this together. But the key to sound government spending policy and maintaining the purchasing power of the currency is having a sound money system. This currency creation, the author says, contributed to the Depression, which occurred in the 1930s. From 1926 to 1931, we saw the British pound sterling that really was not backed by gold. It was not convertible to gold. The U.S. was convertible. The U.S. dollar was convertible to gold to a certain extent. So Great Britain converted British pound sterlings to U.S. dollars, and the other European countries converted their currencies to British pound sterling. So Great Britain devalued the pound sterling, and the other European currencies did the same thing. Rothbard observed this: Britain and Europe were permitted to inflate unchecked. They could create as much currency as they felt like they wanted to. British deficits could pile up unrestrained by the market discipline of the gold standard. Britain was able to induce the United States to inflate dollars so as not to lose many dollar reserves or gold to the United States. So the entire world was inflating in the 1920s. So when currency is debt, rather than something tangible like gold and silver, too much debt is almost always the result. And where we are today actually happened from 26 to 31 in around the world, particularly in Great Britain and other European countries. And then from 1931 to 1945, prior in the Depression and during World War II, there was no gold standard. The U.S. floated its exchange rate. So fiat currencies kind of just floated against each other. Rothbard explained it as you see on the screen, but we leave absolute control of each national currency in the hands of its government. The government then can allow its currency to fluctuate freely with respect to all other fiat currencies. When you hand control of the money supply to the government and expect it to use that power responsibly, that is the mistake that you make. And you'll see the presenter's note there says that when politicians are given nearly unlimited spending power to be funded by currency creation, they eventually crash the system due to unsustainable spending levels. And that's the trajectory that we are now on. History teaches us that that is going to be the end result. Bretton Woods then tied the US dollar to gold after World War II. That's the system that Nixon ended in 1971. Well, why did he end it? Well, if you look at the presenter's note, reckless spending by politicians caused the Bretton Woods system to fail. And Nixon suddenly said, okay, that was the deal, but that's not the deal anymore. The US dollar is not redeemable for gold. And the petrodollar system has propped up the US dollar ever since, but now that may be changing as well. Now, this Mises article talks about, in order to keep the redemption of the US dollar in gold, the government had two options. They either had to cut spending, or if they didn't cut spending, they had to devalue the dollar. Those are still the choices they have, but the consequences of those choices now are going to be a lot more intense and a lot more severe. Well, we all know that dollar devaluation was the option that was chosen. So if you take a look at the 1970s, we had a stagflationary period. Stocks declined in value while consumer prices rose. I believe that we're going to see a similar outcome today. Gold went from $35 an ounce in 1971 to $850 in 1980. Oil went from $3 a barrel in 1970 to just about $40 in 1980. If you take a look at the consumer price index from 1986 to 1985, you see that ever since Nixon eliminated that link between the dollar and gold, we've had boom and bust cycles. The difference was in 1980, the federal debt was not even $1 trillion. It's now 31 trillion. The Fed cannot raise rates significantly. They can't raise rates like Paul Volcker did to get inflation under control to nearly 20% without crashing the economy. That's why I believe the Fed is going to have to reverse course in the future, because they're going to have two choices. They're going to reverse course and they're going to feed inflation, or they're going to crash the economy. And the bottom line is that interest rates are not nearly high enough, in my view, to get inflation under control. So when you take a look at government debt and take a look at the price of gold and take a look at the amount of currency creation that has been used to fund deficit spending and add to the debt, gold prices have increased at about the same rate as debt. And there's a couple charts here that make the point. Now, last topic here is student loan debt forgiveness. This made a lot of headlines this past week. Here's an article on the topic. President Joe Biden's plan will forgive up to $10,000 in student loan debt per eligible borrower, plus another $10,000 for those with federal Pell Grants. The White House's plan will forgive federal student loan debt for borrowers who earn less than $125,000 or less than $250,000 if you're a head of household or you're married and you file a joint return. Along with undergraduate federal loans, the plan covers graduate and Parent Plus loans. This is from the Washington Post. Only those student loans provided by the government, including Pell Grants, qualify for the forgiveness plan. Private loans do not qualify. So student loans made by banks or credit unions or other financial institutions are not included. Nearly 8 million borrowers may automatically have their debt canceled because their income information is already filed with the Education Department. The department could have your information if, for example, you're enrolled in an income-driven repayment plan. If the Education Department doesn't have your income data, details about applying for debt forgiveness will be made available in the coming weeks. The Federal Reserve estimated that at the start of this year, 45 million Americans were carrying federal student loans. For those who qualify under the income caps, the White House plan would erase $10,000 of debt from their federal student loans. Pell Grants, which have been used by 27 million borrowers, would get another 10,000 for a total of 20,000. Now, this is from USA Today, which is not a conservative publication. The White House said Friday that President Joe Biden's action to cancel student loan debt for millions of borrowers will cost the federal government $240 billion over the next decade. That's after they refused to give a cost estimate early in the week. Now, you would expect that, as any politician would do, that they would shade the cost to be more favorable. The Wharton School of the University of Pennsylvania suggested this will cost $519 billion. So somewhere between $240 billion and $519 billion or more. The nonprofit committee for a responsible federal budget said it's about $500 billion as well. So this is $500 billion. How will this be funded? Well, like the additional spending in the Inflation Reduction Act, which, as I discussed last week, will not reduce inflation, this will be funded by deficit spending. And I believe that's another reason the Fed will have to pivot and reverse course. Now, a couple of presenters' notes here. As I understand it, if you've already paid off your student loan debt, there's no benefit to you. And this action, as I just mentioned, like the recently passed Inflation Reduction Act, will lead to more inflation as deficits will widen as a result. That's what I have to cover this week. I'm going to hang out here for a minute and let's take a look at some questions. And it appears that we have a number of questions. So let me run through these. This is from Brad. In your opinion, Should an investment be made into, and Mark, I'm not picking that up.
It's
Physical precious metals. I got it. Brad, yes, I would own physical precious metals. I would limit that to probably at this point 20% of your portfolio. But yes, I would own physical gold, physical silver. That's a much better choice in my view than an exchange traded fund or something not backed by tangible assets. Rick said, is there any way to right the ship? It doesn't seem like changing administration works. Well, Rick, I don't hear any politicians talking about balancing the budget. Balancing the budget at this point would be so painful that it's likely going to be something that at least is not, it won't be addressed, I believe, politically. It will be addressed reactively if it's not addressed proactively. Because deficit spending can only continue to a certain point. And on this course, we have two choices, as I kind of talked about on today's webinar when I pointed out that Thomas Jefferson was right. One, you balance the budget, which would require a 41% across the board spending cut, likely more than that because government spending is a pretty good chunk of GDP, about 20–21% as I recall. That may not be completely accurate, but I believe I'm close. So cutting spending reduces GDP and will shrink the economy. So we're going to have to go through a painful deflationary period. The question is, will we go directly to deflation at this point? Will the Fed raise interest rates to the point that it will get inflation completely under control? And I believe they can't do it without really, that becoming the catalyst for this deflationary period. Actually, though, if they continue on this course, there will be confidence lost in the currency, and they'll have to do it anyway. So I believe that the ship gets righted by going through this deflationary reset. The bottom line is there's too much debt worldwide to be paid, so it won't all be paid, and that will mean that we'll have banking failures and we will have this deflationary period again. And Chris makes a good point here. The $125,000 limit, income limit relating to student loan debt forgiveness is based on 2020 and 2021 tax filings. Therefore, someone who started halfway through 2020 might only make 40K, but the next year make 200K, but still be eligible. Very true. So thanks, Chris, for that clarification and bringing that up. Really good questions. I'm not seeing any more. Really good participation today too. So everybody, appreciate your participation. Appreciate you getting the word out to everyone about the Headline Roundup webinar. We'll be back again in 2 weeks live. And this is posted on retirementlifestyleadvocates.com as well. If you'd like to go back and watch it or send somebody that way, that is, it's free and it's available. So Mark, I think we can probably conclude, and we'll be back in 2 weeks. Have a great Labor Day.
all right. We'll wrap it up there. Again, as Dennis said, we'll be back on 2 weeks from today. That is September 12th for the next live edition of the Headline Roundup. Have a great holiday week, and we'll see you then. Take care.